buenos días a todos. I think, the mind had in mind that we need to wake up at this time. And to do that, we got three gents in here who are going to cover all the angles. So we're going to cover fixed income, equity, then we're going to cover macro risk, without forgetting, of course, private markets. So I think we are in a situation where everything is shuffling and being reshaped so quickly. Think about private capital, that's completely changing, the classic 60-40 allocation. Think about AI and think about the traditional valuation models, completely being challenged, I would say. So we're going to investigate everything with these gentlemen in here today. Right away, so a quick recap for Gabriel. What did 2025 teach us and which lessons should we carry into 2026?
Yeah, sure. Well, thanks for the question, Daniele. So a few things for us to unpack when we look at 2025. Both. That's a problem.
No.
Can you hear me now?
Yeah.
Okay.
Yeah.
So as I was saying, a few things for us to unpack when we look at 2025. The first one is investors' behavior in general, right? I think looking at flows data, for example, what you see is in 2025, investors were sort of trying, as we say in the UK, they were trying to have the cake, but eat it at the same time. So you see a lot of money going into money markets at one end of the spectrum, but then you see a lot of money also going into the equity markets at the other side, in a bit of an on-off pattern that I think is very telling. The second element that I think is worth calling out was how markets actually reacted to the key events that happened this year. The main one, in my view, being the introduction of tariffs by Trump after he took power in January. But for once, it clearly disrupted the market. We all saw what happened at the end of Q1 and beginning of April. But then we saw what happened after that, where penny markets have sort of, discounted it off. And I think what that leads to is, in terms of lessons, I think the lesson for investors is that investors have to be extra careful when it comes to relying on historical baselines and historical behaviors, because we are in a world that is in such high flux that potentially a new approach might be required.
Okay, interesting view. I think there was a view from Uli about geopolitical risks and your view about being probably underestimated as of now.
Yeah, good morning. I think the markets are totally underestimating geopolitical risks. In particular, if you look at you could consider political risks, trade wars. You can consider them what is happening in Ukraine with Russia. And as a result of that, it will create volatility in our markets, which we haven't seen in the past for a very long time. It, I have to say, given that I've been in the market for a very long time, I've experienced some of that. And, I think the most important thing for me is, and for us in our investment space in high yield, is that you pick the right companies and you invest. You're not going to be a short time fly on the wall, and picking the right investment ensures you have the right outcome. So fundamentalism is very much to the forefront if you have risks which you cannot control coming from left, right, and center. It might be Trump with tariffs, might that be a war or whatever.
Okay, interesting. Talking about now asset classes and going into equities, for instance. Michael, looking at you now. So equity valuation, I did touch on AI completely challenging the valuation models, traditional ones. What do you think about valuation at the moment, especially when you compare Europe versus US?
So I think if you look at returns over the last year, you might get the impression that equity markets have blown out, that the valuations were way overvalued at this point. But the good news is that if we look at a DCF, a bottom-up basis, there's still some upside both in the US and in Europe at the moment. We're talking 3-4%. It's not 20-30%, but there is still some upside at this point, thankfully.
Okay. Then moving on to fixed income. I mean, Uli, you are an absolute expert over there. Last time we spoke, you mentioned there is a question which I get all the time.
Spreads are
Sir.
Spreads are tight. And in particular, in high yield, I get this question at every meeting. And what I would say to you, spreads are tight for a very good reason. When defaults are low, spreads are tight. When yields are higher, spreads are lower. And the other thing what we don't talk about is the high yield market is not growing. Supply and demand is pretty flat. Companies, and this is, I think, something which has materially changed over the past 25 years I've been doing high yield. Companies are not increasing the amount of debt they want to have, rather the controversy. So we're reducing debt. And as a result of that, the underlying credit quality in high yield has improved from about 20% of double Bs in 1998 to about 60% today. And guess what? Spread should be tighter.
How do you link that follow-up question to 2026? What to expect?
I think spreads continue to gyrate tighter, probably not to the magnitude we have seen. And please remember one thing. The asset class called high yield, not called high spread. So we're looking to get paid an appropriate return in absolute yield and absolute total return. I'm not in the game of buying something for spread tightening. I want to, when we make an investment at Insight, I'm going to lend money to a company and I want to go from plan A to plan B. And when the refinancing comes, I'm going to get a coupon. I got some capital gains and I get repaid. Then next.
Thank you, Uli. Staying into Europe and looking at opportunities for Europe, Gabriel, I'm looking at you. Where are the opportunities and in which asset class?
Yeah, great question. Hard to say, honestly, because when you look at Europe in this last year, and there are two things that I think are worth being called out. The first one is you see European assets really doing really well and outperforming in local currency terms. But when you look at flows data, you don't necessarily see inflows matching what you would expect for that outperformance. I'm not saying it's such a strong mismatch as you see in extreme examples like the UK, because when you look at the UK, it's been happening for the last 20 years, and every year, it doesn't matter what happened with the assets, it's always negative. It's always net negative, always outflows. But there was a mismatch. You still see when you focus in Europe, you still see a lot of money going into money markets designated in USD, a lot of money going into equity large caps in the US. I mean, if not for the month of July, 2025 would have been positive for that specific category. What I think is positive is that you see after a few years, something changing in 2025, which is Europe is buying Europe again. You see money, European money, going into funds that actually focus on deploying towards European assets. And that's actually very positive. And you can see that some other events actually fitting into that momentum. For example, the German investment program is a key example of an initiative that can feed into that and lead to a positive 2026. Now, what that really means in terms of which sectors, industries will eventually win, I think, again, hard to say. But I do think it will be more of a granular, localized impact as opposed to an overarching renaissance-like halo effect.
Okay. My favorite question, Michael, goes to you. Private markets. I mentioned previously, seems like the 60-40 portfolio. Is it dead? Is it being changed? How is it?
I'm honored to get his favorite question. I think it's evolving. Markets evolve anyway, but we've seen investors more interested in their own portfolios in the last few years than ever before. You've seen the gold price rocket. You've seen interest in crypto and assets like these. And private markets have offered huge returns over the last few years with seemingly lower volatility. So it's not surprising that investors are interested in this and they're asking more questions. How do I access this, etc.? And private equity firms obviously are very happy to make that more and more accessible to investors. So I don't think it's a huge surprise to say that we should see private markets and the convergence of private and public take more shape over the next few years and become more prominent.
So do you see that taking more and more out of the portfolio? Are we going to get to the 10%?
It's whether it comes out of equities or it comes out of another element of the portfolio remains to be seen. And I think that depends on how strong the returns are in equities as well, whether they can hold their own. But certainly something's going to change.
Okay, thank you. Uli, I just realized we didn't talk about inflation. Will inflation hit in 2026?
No. Inflation will continue to be troublesome, and I think people will be surprised with regards to interest rates. It will anchor long-term interest rates at a minimum level, in my opinion. And quite frankly, for everyone in this room, you hear what the central banks are telling you what inflation is, and you and me, we know exactly that these numbers are materially below what they really are. And I think it will have further consequences down the road, because the consumer, and in particular the bottom end of the consumer, is really struggling, and they will continue to struggle, and it's going to get harder. That I think that's one of the problems we're going to face. I also think that the European Union, as you've already seen, is starting to put tariffs on steel with regards to imports from China. This is the beginning. Because what China at the moment is doing, dumping product into Europe with illegal barrels from Russia at $30, putting European corporates to a disadvantage about $30 per barrel. And you're going to see that in chems. And I don't know if you've seen this yesterday. Ineos, the big chem company in Europe, put a huge complaint to the European Union, I think 13 or 14 for anti-dumping. So I anticipate we're going to see trade barriers put up by the European Union to protect its domestic industry. And that, of course, will have impact, maybe not inflation going up. It will stop inflation going down.
Okay, strong statement. We are into risks now. And talking about risks, I would like to touch on market concentration. Michael, can you tell us more?
So market concentration is something, again, people are talking about more than ever. And to some degree, we're a victim of our own success, particularly in the US, where you've seen the Mag 7 rise massively over the last few years. So whether you realize it or not now, you're hugely exposed to certain stocks. NVIDIA is almost 7-8% of the US market, almost 6% of the global market. So we all have this exposure. And whether these companies can continue to produce the growth that they have been over the last few years is going to affect all of our market returns over the next few years. So, when I look on paper, the US market is still less concentrated than markets like the UK. But the difference is it's all based in one specific sector and one specific area in terms of AI. So all our eggs are in that basket in terms of growth going forward, and that's the risk.
Okay. We're good on time. Still on risks, I would like to hear from you, Gabriel. Is there any risk that no one is talking about but should be?
Well, I wouldn't say that no one's talking about, because, for example, Michael just mentioned that, but I think it's worth kind of focusing a little bit on that point. But the risk I would like to call out is, what will really happen with AI in 2026, and what will that mean to the US mega caps? So, as we know, AI has been dominating the political agenda, policy debates, CapEx investments as well. But will it deliver on those promises? And as we were talking before, you see the scenario forming for both possibilities. As we mentioned, we see a lot of money going into money markets for denominated USD dollar terms. Could it be investors actually just parking their cash and eventually waiting for a correction to come before they actually deploy that? Well, maybe. And you also see the rally happening associated with those, driven by those mega caps and highly anchored by AI expectations. And I think the question really stands around, what is really going to happen. And the risk I see is that in a high stakes game like this, when you have a lot of money at two opposite sides, I mean, we all know what can happen, right? I mean, at some point, it will be from the panic, I think.
Interesting view. What's your point on no one risk that no one is talking about? What should be?
Well, as I said, these are. I'm not so worried about internal risks from within high yield, for example, for companies, etc. I'm not worried about a material increase in defaults. Private credit is helping there because a lot of companies which used to come to our market are now being collected. Well, private credit is driving the garbage truck. They're taking stuff we don't want to take into their realm. Doesn't mean that there are plenty of good private credit managers, but if you have excess of capital chasing for a significant reduced amount of assets, mistakes will be made. And I think that's one of the risks people are totally underestimating. And Michael talked about, lower volatility. Yes, it's lower volatility because these assets are marked at par until they aren't. And they aren't when the fund comes to maturity. And I think these are the risks the market is not pricing in. I can't price that. I'm concerned about that. Is that going to happen during my lifetime? Maybe, maybe not. But it's one thing to think about.
Michael, what's your view?
So there's loads of risks, and I agree with Uli on that one for sure. One that I'll take one of your points as well and maybe bring it further is around the consumer and the health of the consumer. So the consumer generally is in relatively poor health. We've had high inflation over the last few years, salaries that haven't kept up with inflation, and we're waiting for consumers to start spending money again because that's what's going to grow the economy over the next few years. But the danger is unemployment is creeping up across the board. Amazon announced 14,000 layoffs just a few weeks ago. And the big question is, are there going to be enough people in employment to actually spend and drive that consumer growth?
Still on risks and touching maybe on contrarian views. Uli, I'll go with you, okay? Is there any contrarian view that someone in the room might disagree with?
I think, being controversial, like I always am, the US economy is in recession. We just haven't noticed yet. It's been propped up by the top 20% of consumers and by AI spending. Because if I look, and I'm a bottom-up guy, if I look at the consumption of PVC, pipe, window siding, cardboard, all telling me we're shrinking. So we have a very not only bifurcated equity market where the Magnificent Seven have propped everything up. Small caps are telling you a very different picture. So, and similar, you're going to see the US economy is basically similar bifurcated. If one of those legs breaks, we might go in a recession. Does that mean you should be afraid of investing in smaller companies? May that be with a good private credit manager, high yield or small cap equity? As long as you do your homework, no. Do spreads under these circumstances widen out a little bit? Probably. But those who pick the right companies, who do fundamental analysis and are not just index tree huggers, will do well.
Mike, what's your contrarian view?
Similar point. It's hard to be contrarian when I'm agreeing with the guy next to me constantly. But I think I mentioned earlier that Europe has a similar level of upside to the US in terms of equity markets at the moment. So the question is, why would you invest in Europe, right? Everyone's, you've got the AI boom in the US, you've got such a level of growth, etc. But I think my controversial view is that I would be investing in Europe over the US. I think we mentioned the risk of concentration. Uli mentioned the economy in the US. And I think Europe is in a better place, albeit a lower one, but the trajectory is better over the next few years. And I think if the AI bubble does blow up, suddenly you're going to see fund flows into Europe again. So that's where I would be.
You touch on probably most of the frequently asked question about the bubble. Can you tell us more on that?
So it's obviously different. I get asked this question, I think, more than any other question at the moment. Is AI a bubble? I think if you look purely at valuations at the moment, some of our valuations on the Mag 7, like NVIDIA, we think it's overvalued. Tesla, we think is hugely overvalued. But the likes of Meta, Alphabet, etc., we still see upside to these names. But the danger is increasing as the valuations go up. And as you see OpenAI, we've read about this massively over the last few weeks, they get into more circular deals all the time with the other companies, which increases the risk for the whole group. So if indeed OpenAI, as a group, their big bet that they're doing doesn't pay off, it's going to have ramifications, and that risk just keeps increasing.
This is very outside of what we agreed on in terms of questions, but I got to ask, are they going to IPO, do you think?
It's a good question. I think certainly it has the fanfare at the moment to generate high valuations, which would be hugely attractive. But against that, they have pretty much access to as much credit as they want from wherever they want at the moment. So the question is, why would they IPO?
Okay. Right. So I will need from each of you now, we got some time left, a summary headline for next year, but I guess you can do a quick wrap up and a summary headline. Please, Gabriel.
Yeah, sure. So, quick wrap up. I think if we look back a little bit, so after the great financial crisis, we had a decade or so of relative stability. That sort of went out the door for the last few years, right? We had global pandemic, we had wars and the plural conflicts, and 2025 was no different. It had its own challenges. And when we look at the spectrum out there for investors, you see a bit of a clusterization. You see investors forming based on their own hypothesis and what they believe in going to be happening, but in sort of isolated places. And now the big question coming to the summary is, who's going to win? That's a huge, huge question mark. But I think that's going to be, that will be some important developments for specific groups of investors. And I think, 2026 will be a pretty exciting year for all of us.
So your headline is?
Look forward to 2026. Pretty exciting.
Uli.
Despite all the risks we're seeing, and I think I lined this out quite well, that the risk level or the events which can happen from outside have increased compared to 2025. However, what I think in fixed income, returns remain, because of the yield, attractive enough to mitigate. And in particular, if you are fundamental active, you will outperform most others.
Okay, so your headline in 3 words is? Overweight.
Be overweight, remain invested in fixed income.
Okay. Michael.
I'm going to be controversial and go with investors left disappointed in 2026. And by that, I don't mean that investors are going to go away empty-handed, but what I mean is that the returns that they've seen over the last few years aren't sustainable. Equity markets are already up 15% or so this year. We had 20+% returns in the US just 2 years ago, and that's not sustainable into the medium term. We're going to revert to more normal returns, and investors are going to have to get used to that, and that may lead to some disappointment next year.
Okay, so I think that's all for this session, even earlier than anticipated. We got all the angle covered, as I mentioned. I think, as a key takeaway is just to wrap up. So interesting the point from Gabriel about the money market. Hey, money are going towards large caps in US, but at the same time into money market. So what's going on over there? A couple of strong statements from Uli, I would say, about inflation, about high yields, about, don't forget bonds are still alive and still kicking for 2026 as well. When I look at Michael, interesting stuff about AI valuation, of course. Interesting contrarian view. So I think that's all for this session. Thank you very, very much.